All right, let's dive right into a really powerful Forex trading concept known as the unicorn model. Now, if you're looking for those super rare, high precision entry points, this is for you. It's all about combining two incredibly potent price action signals to find one amazing setup. Let's get into it. So, if you're a trader, you've been there, right? You're staring at the chart, you see a potential setup, but it just feels kind of weak, a little ambiguous. You're looking for that extra piece of confirmation, that edge that turns a maybe trade into a heck yes trade. Well, that's exactly what we're going to tackle, a model that's designed to cut through the noise and zero in on those high probability zones. So here's the game plan. We'll start with why precision is so critical. Then we're going to dissect the two key building blocks, the breaker and something called the fair value gap. After that, we'll put them together to build the unicorn model itself, and then of course, we'll see it in action on some real charts. Okay, first up, the search for precision. Look, in trading, any single signal can be okay, but it can also totally fake you out. The real magic happens when you find what we call confluence. That's just a fancy word for when multiple, separate, strong signals all line up and point in the very same direction. It's like stacking the deck in your favor. And that, right there, is the entire philosophy of this model. We are not interested in just one good reason to get into a trade. No, we are hunting for a very specific spot on the chart where two distinct, powerful price action signals overlap. This little zone of confluence is an area that big institutional traders are almost certain to be watching. All right, let's get into our first building block. This is what we call the breaker block. The best way to think about it is like a footprint, a clue left behind by the big money that signals a potential shift in where the market is heading. So, technically speaking, a breaker block gets created when price smashes through a key swing point. Let's say we're in an uptrend. Price takes out a previous swing high. Well, that old resistance level now has a very high chance of becoming brand new support. It's a classic role reversal. That old ceiling becomes the new floor, and it's a huge tell that the market structure is changing. Okay, take a look at this chart. It shows it perfectly. You see that swing high that was formed? Then, price comes back and pushes aggressively right through it. That's our break of structure. The zone of that original swing high, that becomes our breaker block. The really cool part is that when price pulls back later on, it often comes right back down to this zone, respects it, and uses it as a launch pad to go higher. That's piece number one of our puzzle. Okay, you got the breaker? Good. Let's dive into the second crucial piece of our model, the fair value gap, or as you'll often see it, FVG. This one is all about an imbalance in the market. A fair value gap is a really simple three-candle pattern you'll see when price just explodes in one direction. That super aggressive move leaves behind an inefficiency, a little pocket where price delivery was sloppy. And here's the thing, the market absolutely hates inefficiency. So these gaps act like a magnet, often pulling price back to fill the gap before it continues on its way. And this is exactly what it looks like. It's super simple. You've got three candles in a row. Now look at the space between the high of the very first candle and the low of the third one. The candle in the middle just blasted right through, leaving that empty space. That space is the fair value gap. It's a literal void that price will very likely want to come back and revisit. So we have the breaker block, which is a key structural point. And we have the fair value gap, which is a price inefficiency. On their own, they're both pretty useful. But the real power, the absolute magic of this model, happens when these two things show up in the exact same spot. And the formula is just beautifully simple. Step 1, you spot a valid break of structure and identify the breaker block it created. Step 2, you look closely to see if a fair value gap exists inside that breaker block. And when you find that overlap, bingo, you've found your unicorn setup, a super high confluence zone for a potential trade. And this is the whole point, right? A breaker by itself is a decent setup. An FVG by itself is also a decent setup. But when you stack them, when they're right on top of each other, the probability of price reacting to that specific little area goes way, way up. You have a structural reason and an inefficiency reason for price to go there and then turn around. And here it is. This is that aha moment on the chart. Look at this. The blue box is our bearish breaker block. But look inside it. The yellow box highlights a perfect fair value gap. That tiny little area where they overlap, that is our unicorn zone. It's an incredibly refined, high-precision area to look for your entry, way better than just trading the entire break. Okay, theory is great, but let's see how this actually plays out in the real world. We're going to run through a few quick examples just to really burn this pattern into your brain. Check this out.
Here on the Euro USD 15-minute chart, we get a crystal clear break of structure to the upside. So we mark out our bullish breaker block. And what do you know? Right inside of it, there's a small but obvious FVG. Price pulls back, taps that zone almost to the tick, and then just launches. An absolutely beautiful move. That's precision.
And it works for shorts too. Let's look at a bearish example on the pound/yen hourly chart to see how versatile this is. We get a sharp move down that breaks a previous low, creating our bearish breaker. And right inside that zone, an FVG formed during that aggressive sell-off. Price retraces right back up into that overlap and gets rejected, hard. Just a perfect short entry setup. Okay, one more, this time on gold on the 4-hour, just to really hammer it home. This is as textbook as it gets. You have the break of structure, you have a clearly defined breaker block, and you have a beautiful fair value gap sitting right inside it. Price comes back up, fills that inefficiency right within the structural zone, and reverses. It perfectly illustrates the power of confluence. So, to wrap this all up, here's your checklist. The process is simple. First, you have to see a clear break in market structure. Second, identify the breaker block that it's created. Third, you scan inside that breaker for an overlapping fair value gap. That little confluence zone is your high probability setup. And the last, most important step, be patient. You have to wait for the price to actually come back to your zone. And that's the unicorn model. You know, they call it that for a reason. These picture-perfect setups don't happen every single day. They are rare, and that's what makes them valuable. But by layering these two concepts, you give yourself a massive edge in spotting these high-precision turning points. And the most important thing is, now you know exactly what you're hunting for.